Morning, everyone. It's my privilege to wish all of you this morning at the IEPF seminar. May I request DG NCAER, Dr. Poonam Gupta, to welcome all the panelists and the participants at this webinar. Over to you, Poonam.
Thank you, Dr. Krishnan. Good morning, everyone. It is indeed my great pleasure and privilege to welcome you all to today's event, which is being hosted as a part of the nationwide campaign of the Government of India, the 75-week festival of Azadi Ka Amrit Mahotsav. As we all know, the United Nations adopted SDG 2030 in September 2015 with the idea of leaving no one behind. The Universal Agenda is a comprehensive plan listing 17 SDGs and 169 targets that are integrated with the primary objective of economic, social, and environmental development across the globe. Financial inclusion is a prominent subject under the SDGs. Financial inclusion, as we all know, has the potential to enhance economic growth and thereby accelerate the achievement of all other SDG goals, such as eradicating poverty, ending hunger, promoting health, achieving gender equality of that matter, reducing inequality overall. The high-paced digitization in India has indeed enabled banking to reach many more during the pandemic. It is important to use this growth in digital financial inclusion to ignite faster progress towards the fulfillment of the SDGs and create a long-lasting social and economic impact. It is in this context that we have organized today's event, Investor Education and Awareness for Strengthening Financial Inclusion, Enabler of Developmental Goals in SDG 2030. Our keynote speaker today is Mr. Amitabh Kant, CEO NITI Aayog. He will highlight the government's perspectives on financial inclusion. We are very pleased to have other panelists with us, Mr. Atul Bagai, head of the UN's Environment Program in India, who will speak after Mr. Kant, and he will offer international perspectives on this issue. Ms. Bindu Ananth, Chair and Managing Trustee, Dvara Holdings, and Mr. Challa Setty, MD, State Bank of India, will present views from the Indian financial sector. Mr. Manoj Pandey, CEO, Investor Education and Protection Fund Authority, will offer the closing remarks. So with that, again, a very warm welcome to you all. And let me turn the floor over to my colleague, Dr. Krishnan. Thank you.
Thank you. Thank you very much, Dr. Gupta. I would like to join her in welcoming our esteemed panelists and the august audience gathered for this webinar. The IEPF unit of NCAER, which is about a year plus old now, primarily focuses on issues relating to investor education and protection. At your convenience, I'd like to invite you all to visit our website and see the range of activities that have been undertaken by us over the last year plus to further interaction and advocacy on these two critical issues, awareness, education, as well as investor protection. Now, turning to today's program, we are, along with the IEPFA, the Investor Education Protection Fund Authority, which, as you all know, is a statutory body established under the New Companies Act of 2013. Together, NCAER and IEPFA are holding this event as part of the celebrations of Azadi Ka Amrit Mahotsav to mark 75 years of our political independence. Clearly, however, a very important aspect of independence from the colonial power was economic independence. Those of us who are from the financial sector here clearly recognize that finance is, in a sense, the brain of the economy. And I use this phrase to essentially signal the allocative function that the financial system performs in terms of allocating resources across competing uses, as well as building up the framework for risk mitigation for the entire economy. A well-developed and deep financial system is therefore important for what I think is full and true Azadi. The theme, therefore, that we have chosen for our webinar today is the Sustainable Development Goals and Financial Inclusion. Sustainability has many dimensions. One of the important dimensions of sustainability is resource sustainability. And it is this aspect that our first speaker of the day, Mr. Atul Bagai, I expect will be focusing on. Investment and hence production systems which promote environmentally sustainable growth is now adopted both by the public and the private sectors. And these sustainability issues from an ecosystem point of view, from an environmental point of view, is what we expect Mr. Atul Bagai will be guiding us on. Sustainability also has a clear social dimension. Socially sustainable markets, in my understanding, are those that are both inclusive and participatory. Inclusive finance has, in turn, further dimensions, and our second speaker for the day, Madam Bindu Ananth, will focus on these aspects besides other areas that she would like to throw light on. Finance needs to regenerate itself, and financial sustainability of investments and lending is the key to a long-term and stable financial system. How the financial sector, the more organized formal banking system in particular, focuses on internal sustainability of the financial system while focusing on external sustainability aspects is something that our third speaker, Mr. Shetty of the SBI, I expect will be focusing on. Besides these dimensions of sustainability, capital is mobile and constantly looking for opportunities for the best return, including across borders. Many small countries with wealth have developed financial systems that are entirely dependent on export of financial services to the rest of the world. However, a continental-sized country like India cannot and should not be attempting this. Fulfilling the needs of the large internal market is the sense in which I believe India is poised to become Atmanirbhar, at least in the financial space. But equally, I think given that we are a large country, there is a lot that the rest of the world can offer to us, and offer to us not only in terms of resources, but also in terms of best practices. I am reminded here of what our sages said long years ago, Ano Badrah Kratavo Vantu Vishwatah, namely, let noble thoughts, and I would add, noble thoughts and any resource that is of use to us flow to us from the rest of the world. I expect that our keynote speaker for the program, Mr. Amitabh Khan, will perhaps try and bring all these aspects, domestic, external, social, and resource sustainability in a very global sense in his address. So the expectation, ladies and gentlemen, is that today's conversation with the esteemed panelists and the keynote speaker will explore all facets of sustainable finance in making it truly inclusive. We keenly look forward to all the presentations of the learned panelists and hope to take away from this webinar a set of next steps for our regulators as well as policy makers for their consideration for implementation. What I propose to do in terms of the organization of the program for the rest of the afternoon is that I will call upon each panelist and do a very brief introduction and also, if necessary, carry out the unpleasant task of announcing that the panelist is close to his or her time. I don't believe it will be needed. I expect all of us to be disciplined. The keynote speaker, as I mentioned, for the program is Mr. Amitabh Kant. Amitabh is currently the CEO of NITI Aayog. He is a member of the Indian Administrative Service Kerala cadre of the 1980 batch. He superannuated from government, from the Indian Administrative Service to be more precise, a few years ago. He has authored Branding India, an incredible story in 2009, and Incredible India 2.0 and Synergies of Growth and Governance in 2019, and The Path Ahead, the Transformative Ideas of India, which was written in 2018. He has been a key driver of award-winning initiatives such as Make in India, Startup India, Incredible India, and God's Own Country that have positioned both India and the state of Kerala as a leading manufacturing as well as tourism destinations. He has pioneered many initiatives, all of which I will not have the time to explain today. Suffice it to say that he is a key thinker of many of the initiatives of this government. With your permission, ladies and gentlemen, we will now play Amitabh's video recorded presentation of the keynote address, as he himself had to step away for an interesting conversation, namely the COP16, the program that's very soon going to happen, focusing on sustainability. I believe there is a cabinet meeting right now underway, and Amitabh has to go for that. So we have a video recording of his keynote address, which, with your permission, we will play now.
Ms. Poonam Gupta, the Director General of NCAER, Mr. K.P. Krishnan, the IEPF Chair Professor of NCER, distinguished guests, ladies and gentlemen, I'm delighted to address you all today as part of this webinar on strengthening financial inclusion, enabler of development goals in the SDG 2030. As we all know, to celebrate India's 75 years of independence on 15th August 23, the Government of India has announced a 75-week festival of Azadi ka Amrit Mahotsav. I'm glad to note that as part of this nationwide campaign, the Investor Education and Protection Fund Research Chair Unit, NCAER, is organizing a webinar highlighting the ways to strengthen financial inclusion using investor awareness and education. Financial inclusion is at the very core of the development efforts of the government and is a key enabler of the development goals envisaged under SDG 2030. Since the theme for today is also deeply linked with SDGs, we must understand that our ability to further deepen financial inclusion directly relates to a number of SDGs. SDG 1, for instance, talks about eliminating extreme poverty by providing the vulnerable with services they need to make investments and manage unexpected expenses. Financial inclusion greatly facilitates the achievement of the first SDG. Similarly, SDG talks of reducing hunger and promoting food security. Today, millions of farmers across the country are receiving direct benefit transfers under a number of government schemes. Providing access to finance to farmers will lead to enhanced productivity and more bountiful harvests, leading to progress on the second SDG. Financial inclusion improves health by giving people the ability to manage medical expenses and rebound from a health crisis. And this relates directly to the third SDG of achieving good health and well-being. It also promotes gender equality, which is enshrined in SDG 5. Financial inclusion helps women assert their economic power, which is key to promoting gender equality. The United Nations adopted SDG 2030 in September 2015 with the idea of leaving no one behind. Financial inclusion is one of the prominent subjects under the SDGs. Low levels of financial inclusion are normally associated with poor financial literacy and financial awareness. India has made a conscious paradigm shift to a whole of society approach by engaging all key stakeholders, subnational and local governments, civil society, communities, and private sector in collaborative adoption, implementation, and evaluation of the SDGs. India is taking a lead role in implementing the framework, monitoring the progress, and bringing on board various stakeholders in the journey towards achieving the targets. What we have achieved in terms of financial inclusion is quite inspirational. In fact, I would say it's nothing short of making a huge paradigm shift. We started at the bottom of a pyramid when it came to furthering financial inclusion in the country. A massive drive towards opening bank accounts was undertaken. Financial inclusion initiatives witnessed the largest impact in recent years with the launch of Pradhan Mantri Jan Dhan Yojana in 2014, which has resulted in almost every household having access to formal banking services, along with a platform for availing low-value credit, insurance, and pension schemes. How has such a mammoth feat been achieved? It has been made possible because of what we popularly known as the JAM Trinity, the Jan Dhan bank accounts, Aadhaar cards, and mobile phones. We have 1 billion plus biometrics, 1 billion plus bank accounts, and 1 billion plus mobile phones. We have brought services to the mobile phones of the Indian citizens. Payment services are just a click away from millions of Indians. India stack with its conglomerate of application programming interfaces, APIs such as Aadhaar authentication, eKYC, eSign, UPI, etc. has allowed governments, businesses, startups, and developers to utilize the public digital infrastructure to offer varied financial services and has catapulted adoption of cashless behavior. In fact, financial inclusion today is totally enabled by digitization and technology. Our UPI platform is testimony to this. The government wants to take a platform approach to solve for the challenges that we face, right from deepening financial inclusion to making education available and accessible to all. UPI was built on a public-private collaboration model, and because it's a platform, we have actually allowed so many private sector players from PhonePe, Paytm, Google Pay, Samsung Pay, and startups to build world-class products on top of this. The payment app on your phone, whichever one you use, is running today because of the UPI platform. Scanning a QR code to process a UPI payment for small and big transactions is rapidly becoming a way of life for our millions. Interestingly, over 80% transactions on UPI are peer-to-peer, reflecting a replacement of cash and an increasingly digitized economy. In August 21, UPI logged a record-breaking 3.5 billion transactions worth 6.4 trillion Indian rupees. American tech giant Google wrote to the US Federal Reserve praising the system and encouraged the implementation of such a payment system in the US. The basic approach to improving the adoption curve has been to solve for products that have maximum use and provide least amount of friction with respect for adoption. Payments was the first product which needed to be solved for. The need for financial services is universal and fundamental in nature. The private sector has always played a key role in this space, and with the advent of innovations through fintech, the government has provided a level playing field and encouraged innovation through an enabling policy framework. As of earlier this year, there were close to 400 payment startups in the country. Mobile, digital wallets, gateways, POS, mobile POS segments and subsegments account for over 50% of the payment startups in India. With payment problems solved, the focus of the ecosystem then shifted towards lending. In the lending segment, there has been an emphasis on both consumer as well as MSME-based lending. Fintech has allowed innovation in this space, allowing for new models to come up, such as flow-based lending. Some of the leading companies in the space are Lending Card, Pine Labs, MobiKwik, etc. Once there was sufficient comfort with payments and lending, the focus then shifted towards personal finance and money management. A plethora of entities have come up recently in this space, and just to name a few, we have Jeroza, Grow, Upstock, and now we are witnessing the emergence of financial products which target the slightly more complex segments. For instance, the new insurance tech companies such as Digit and Acco are greatly simplifying insurance, covering the end-to-end life cycle of origination, underwriting, claims, and selection. In the past, legacy financial institutions have tried to solve for everyone with the solution being focused on select high-revenue customers. The fintech ecosystem has upended this traditional approach, with more customized products being made available for different groups, paving the way for emerging neobanks. Neobanks have come up focused on millennials or gig economy workers, such as IEPFA, Jupiter, and FAMPay, which is a neobank for students. India has also taken a strong leadership role in the open data for finance space. It has already operationalized a concept where exchange of financial information from fiduciary to the end user takes place through the consent of the consumer. The consent framework has gone live with the account aggregator system. The account aggregator ecosystem, pioneered by RBI and government sector, will help democratize access to data in the ecosystem through a consent management and help in developing new use cases in lending and financial management. Our efforts to create a robust ecosystem for fintech-based solutions in India to thrive has led to a greater investor confidence. In the first 3 quarters of 2021, US $4.6 billion worth of investments were recorded in the Indian fintech space compared to a mere $1.6 billion in 2020. With greater financial inclusion, there is a need to enhance customer protection and financial education. The segments of the population who are really in need of these interventions are also the most vulnerable and open to be exploited. The National Strategy for Financial Education, released by RBI, envisions to make financial services available, accessible, and affordable to all the citizens in safe and transparent manner. Subsequently, the National Center for Financial Education was set up by 4 financial sector regulators as a Section 8 company to promote financial education across India for all sections of the population. Similarly, the Center for Financial Literacy project is an innovative way to impart financial education through community approach. The project was conceptualized by the RBI in 2017 as an innovative and participatory approach to financial literacy at the block level, involving selected banks and NGOs. Initially set up in 100 blocks on a pilot basis, the project is now being scaled up across the country to every block in a phased manner by March 2024. There is no dearth of evidence which proves that financial inclusion models can strongly support overall economic growth and achievement of broader development goals. Vast amounts of data are being generated through various platforms in India now. We are already data rich, but now the key is to move towards becoming data intelligent. We must use and leverage disruptive technologies for further financial inclusion in India. We must use artificial intelligence and machine learning to push the limits of financial inclusion. With a robust regulatory system, we are well poised to leverage the data and innovate further through our sandboxes and account aggregators. Supplemented by the platforms approach taken by the Government of India, the Indian fintech ecosystem will leapfrog as it caters to the aspiration of 1.3 billion plus Indians. Through greater public-private partnership and an enabling policy ecosystem, this will usher in a new era of financial inclusion in India. Thank you very much, ladies and gentlemen. My best wishes for this webinar series, and I really thank Mr. Krishnan and Ms. Poonam Gupta for giving me this opportunity to deliver this address. Thank you very much.
Thank you on behalf of all of us in absentia to Mr. Amitabh Kant. It is now my privilege to call upon Mr. Atul Bagai. Atul joined the UN Environment's Ozone Action Program under the Montreal Protocol as the Regional Officer for South Asia in 2000 and served as its Senior Regional Coordinator to build the capacity of sub-regional networks in Asia and enable them to meet the compliance targets under the Montreal Protocol. In that capacity, he spearheaded and led some innovative initiatives with the Executive Committee of Multilateral Fund. Besides India, these have been in Maldives, Bhutan, Mongolia, and Nepal. Prior to joining the UNEP, Atul worked with the Government of India and the Government of UP for 17 years in a number of positions, including senior positions such as Chief of Staff to ministers at the federal level, at the union government level, Ministry of Finance and Ministry of External Affairs, and to a Chief Minister at the provincial level in the state of UP. He also served as the Ozone Cell Director at the Ministry of Environment and Forests, Government of India. Mr. Bagai holds a postgraduate degree in history from the University of Delhi. Over to you, Mr. Bagai. We are very keen to hear you on international perspectives on the issues that we are discussing. Thank you.
Thank you, Mr. Krishnan, and thanks, Poonamji, and my greetings to all the esteemed panelists. In fact, most of the listeners and panelists must be thinking what an environmentalist is doing amongst the financial wizards, and what is that linkage of linking sustainability and environment with financial services, and that certainly is an issue which this program of investor education, which NCAER is working on, is a very good approach to highlighting the importance of sustainability and environment in financial health and financial inclusion. My approach would be that environment and sustainability is as important or as integral to finance and to financial health as is money. And this is a realization that slowly is being dawning on financial world globally. Just to give an example, the COVID-19 pandemic, which we all are going through, is largely an impact of zoonotic diseases that have been spreading as a result of biodiversity and ecosystem losses. And for the recovery packages that more or less every government had to bring money on the table, running into trillions of dollars, was an expense that could have been used for much better services for the vulnerable and the poor. So the environmental damage that is happening needs to be recognized and needs to be looked at in terms of how it's impacting on financial services and financial health. And I think that is the key to my talk today. And I would like to divide my talk into two broad areas of discussion. One, how financial inclusion as part of SDGs is very important for achieving the SDGs 2030. And Amitabh gave so many examples of how India is addressing this. And the second one, I'll go and talk about the investor education and investor looking at how financial services can adapt to the environmental changes that are taking place. I would certainly say that financial inclusion and sound financial health are cornerstones of SDG realization. And in fact, they feature as prominent targets in 8 out of the 17 SDGs. There have been numerous studies that have been done that have proven that financial inclusion helps in meeting SDGs related to poverty or to health, to education, to food security and gender equality. And Amitabh mentioned a few of those examples. I'll give one global example to highlight that the results of a long-term impact study on a mobile money service in Kenya, which was M-Pesa, found mobile money has lifted as many as 194,000 households, which is 2% of the Kenyan population out of poverty, and has been effective in improving the economic lives of poor women and of members of female-headed households. So it is acknowledged that financial inclusion is a very important and integral part of achieving the SDGs 2030, and especially during this decade of action that is being implemented from 2021 to 2030. In fact, a lot of these issues are going to come up, as KP Krishnan was mentioning, in the forthcoming COP26 in Glasgow, which is going to start in a few days' time. And I think financial inclusion is one of the most important elements of discussion and negotiations in that COP. And it also is so important because I think there is a global recognition that financial inclusion gives people the means to improve their development and also their own lives. I will not go into too many examples, but what I'll try to say is, from a UNEP perspective, which I represent, which also I'll try to bring in the international perspective, how do financial inclusion and SDG realization should consider some of the important elements while you are devising various financial products and financial services. And I think the challenge is to ensure that this inclusion also becomes an important instrument for addressing environment-related SDGs more proactively. I think through all financial services, we need to start looking at them through not only money lens, but also through the environment lens. How can, for example, Pradhan Mantri Fasal Bima Yojana or a crop insurance scheme for small farmers, and Amitabh mentioned about these schemes, but I'm adding another element. How can these schemes also provide an incentive for sustainable and climate resilient agriculture? And that's a very important consideration, considering that agriculture now forms such an important element of the carbon emissions that we need to reduce. How can concessional credit for MSMEs like Mudra, for example, also incentivize energy and resource use efficiency? How can incentives for microgrids be linked to livelihoods? And this is some work that we are doing with Khadi and Village Board in Uttar Pradesh. And we need to scale it up and we need to bring functional models. For financial inclusion, how can we translate empowerment and environmental sustainability through capacity building? And this was also mentioned by the previous speakers. We are working closely with Seva in Gujarat of how renewables can be used in the interiors of Kutch for the salt pan workers, not only to build their capacity, but also to provide livelihoods. I think financial inclusion must also facilitate inclusive access to basic services of waste management and sanitation. And of course, the linkages with health need to be also emphasized. And this, I think, is a very big missing link. And we need to really look at how we can address these issues. And broadly at a macro level, certainly, it's not only the private sector or the investors, but the public funds would also need to require similar criteria in their resource allocation and resource mobilization. I'll speak a little bit about how is financial inclusion so important for climate change and from an India perspective. And India is one of the world's most vulnerable countries to the effects of climate change. And Glasgow really brings in focus the efforts towards this regard. And the kind of losses in terms of economic losses in terms of money and the losses in terms of jobs and workforce due to climate change needs to be an important element for any kind of financial allocation and any kind of financial services that need. And this close linkage between climate action and financial inclusion needs to be a means of building not only resilience to climate change, but also it would be a key step in building adaptive capacity and references and resilience amongst the most vulnerable parts of our society. There are many examples in this regard, and one of very good example is the Africa Center, which I would urge NCAER to very closely look at the Africa Center model, where they have gone a step ahead on insurance and have actually prevented or protected the most vulnerable parts of the African society against the climate risks. And this model is something that we need to also enhance and scale up in India. I will now go on to the second part, where what is UNEP doing in this regard? And I would like to highlight our financial initiative called the UNEP-FI, which was set up in 1992 as a platform to convene investors, banks, and insurers to take action on sustainability. And I see today that SBI is also represented in this panel, and I'm sure amongst the audience there would be many people attached to banks, insurance, and investors. And I think I would like to highlight a little bit of what we are doing under this financial initiative. It is one of the oldest sustainable finance initiatives in the world, and today works with almost 430 financial institutions who are committed to mainstreaming ESG into their businesses. In fact, over the last 30 years, UNEP-FI has seen sustainability issue evolve within the finance sector, and we brought out a very groundbreaking report which identified that there were some environmental, social, and governance issues that were material to investment performance. And I think that is a very important issue that needs to be looked at, that the investors need to start understanding that the investee companies are not only in violation of any national laws, for example, discharging harmful chemicals into the river or use of child labor, but also now they are starting to look at much broader economic, environmental, and social issues that are very, very important. Over 400 Indian companies are signatories to the UN Global Compact, which is a voluntary commitment by businesses. I will conclude my talk today with just recommending a few action points for the investors. And I'll highlight 4 or 5 of those. I think the investors need to understand the science of sustainable development. And when I say investors, I also would like to include the private sector and the government sector. In fact, they should use the SDGs and the Paris Climate Agreement as a guide to integrate ESG in their investment decision making. And this is a very critical part of decision making that needs to be integral to all companies, to all government departments, and to all private individuals. For implementation, they should study the international sustainable finance frameworks and initiatives such as the principles of responsible investment, the principles of responsible banking that UNEP has brought out, and the Task Force on Nature-related Financial Disclosure, and the Net Zero Asset Owner Alliance. Finally, join the global community of ESG investors to feel firsthand the unprecedented scale of change that is rapidly unfolding in the global capital markets. Only then would investors understand that sustainability is no longer an option to which all investors must be urgently educated to be part of the solution. Financial initiative I was just talking about, where we have 430 partners, I would seek support from NCAER to get as many Indian banks, as many Indian financial institutions to be part of this global effort. I'm sorry to say that we don't have more than 1 or 2 Indian financial institutions who are part of this financial initiative, which actually with its 430 members covers almost a few $1 trillion economy globally. I will end my talk here and would look forward to questions during the question and answer session. Thank you.
Thank you. Thank you very much, Atul. That is a very comprehensive coverage, both of the environment, sustainability issues, as well as the international dimensions of the subject. I really appreciate your taking time out and joining us today. It is my privilege now to call upon Madam Bindu Ananth, Chair and Managing Trustee of Dvara Holdings, formerly known as Dvara Trust. Bindu used to chair the board of Northern Arc Capital between 2009 and 18. Prior to this, she worked in the ICICI Bank's microfinance team that was between 2001 and 2005 and was head of the new product development team within the rural banking group of ICICI in 2007. She has an undergraduate degree in economics from Madras University and 2 master's degrees, one from IRMA and a second one from Harvard University's John F. Kennedy School of Government. She has co-edited a book published by SAGE entitled Financial Engineering for Low-Income Households. She has also published extensively in the EPW, the OECD Trade Paper Series, and the Small Enterprise and Housing Securitization and the Task Force on the Insolvency and Bankruptcy Board of India. Binduji, over to you. We look forward to hearing your views on financial inclusion and sustainable development goals. Thank you.
Thank you, Dr. Krishnan, for that kind introduction, and Dr. Gupta. I'm very grateful for the opportunity to participate and to share some of our insights. At Dvara, what we do is essentially enable the participation of low-income households in the formal financial system, I think for all the reasons that we talked about already. And the way we do this is through research that is policy-focused and actionable, hopefully, and also a focus on business model innovation. We have a specific focus on rural India, where we currently serve over 1 million households with access to basic financial services. As Mr. Kant described very eloquently, so I will not repeat that. As a country, I think we've made tremendous gains in financial inclusion in the last decade or so. We are, I would say, within striking distance of making access to basic bank accounts, what we call in the business no frills, and also access to payments, account-to-account transfers, etc., universal. For a country of our size, I think that is not a trivial achievement and certainly something to be proud of. The challenge, however, now, I think as a lot of new data seems to be indicating, most recently we've got results from the All India Debt and Investment Survey, is really to enable active usage of these accounts and assets so that at the end of the day, households can build corpus, meaningful corpus against old age, inflation, and so on, and also protect against risks, most significantly events like accidents, health, shocks, and so on. A lot of data indicates that physical assets, specifically land and gold, are still really the predominant way in which Indian households are, managing their wealth or allocating their assets. Something like 90% of household wealth in India is held in the form of physical assets. So to me, at least one metric of financial inclusion is going to be to say, how do we over a period of time transform balance sheets of households so that they benefit from participation in the broader financial system. In addition to this sort of issue, the other thing we worry about a lot is the persistence of non-institutional or informal debt. This is particularly true in rural India, where about 1/4 of borrowing is informal. So these transitions in particular, I think the transition from physical assets in balance sheets to financial assets, and informal borrowing to formal borrowing, I think will require continued focus, both from policy as well as practitioners. But also, what I hope to spend most of my time today talking about is a sustained focus on customer protection and grievance redress, because what we've done through all of the hard work over the last decade is created tens of millions of new to the system, new to bank customers. And therefore, the experience of this new generation of customers, are we able to give them the confidence to transact? I think that's really going to determine our trajectory going forward. So what I thought I might do today is really spend the rest of my time focusing on 3 case studies, very short, but really ones that to me are at the coalface, so to speak, of financial inclusion. And that will hopefully bring home what are some of our persistent challenges and sort of the duality of a lot of technology, but at the same time, a lot of exclusion. So I thought I might do it through sort of 3 case studies. The first one I want to talk about is direct benefit transfers, specifically the phenomenon of transaction failures in DBTs. As many of you know, immediately post-COVID first wave and lockdown, there was a surge in AEPS transactions. I think there was something like 400 million AEPS transactions in April 2020. Unfortunately, this rise in transactions was accompanied also by significant failure rates. I think the average failure rates in that period was something like 40%, which means 4 out of 10 people experienced a failure in a simple transaction such as, I have money in my account, I want to withdraw it. I highlight this case because I think it is illustrative of, when there is sort of a with the financial system, can we build success? Can we build confidence? So that's sort of one, and maybe Mr. Setty also can comment on this in the Q&A. So this is, I think, an instance of we have world-class technology, no question about it. We were able to get out of the gate much faster than other countries in terms of DBT. But at the last mile, we are still, I think there is work to be done in terms of making sure that access is reliable, and that we really think about how to bring down these failure rates, reduce rates of fraud, so that people sort of have the confidence in the system. The second case I want to talk about is, disclosure failures, overall in financial assets, but specifically in the context of 81 bonds and Yes Bank, which was also something that happened early last year. As all of you know, mis-sale of financial products, it's not just an inclusion problem, it is a challenge that the entire Indian financial sector has really grappled with. Our own research shows that banks rarely make voluntary disclosures on product features. And when specifically requested by the customer, information provided is inaccurate and often incomplete. In some recent work done by our team, NITI Aayog et al., they conducted an online experiment to study the impact of information disclosure on consumer behavior with respect to purchase of a financial product. This experiment, very briefly to give you a sense, involved an online survey that presented the respondents with a hypothetical scenario where they were asked to imagine that they had savings worth rupees 5 lakh that had to be invested in some kind of long-term investment product. The product that was offered was a hypothetical high-return bond from a hypothetical OCOC bank. And all of this was done to really elicit actual behavior of consumers if they were in this position. And then what was interestingly done was, in order to tease out what the impact of information disclosures are, 2 variations of information disclosure were provided to the people who participated. One was what we call an accurate disclosure, and the other was an inaccurate disclosure. Really, the difference between the two was the inaccurate disclosure only emphasized returns, whereas the accurate disclosure emphasized returns as well as risks, in the same sentence in comprehensible English. And for those of you interested, there's a full paper on this. I think NCAER did a seminar on this paper recently. And stunningly, what the research found was that the odds of buying the product when the consumer was exposed to the accurate disclosure were 80% lower compared to when they saw only the returns pitch and not the risk sort of picture. So I think this is an interesting reminder, and of course this is an experiment, and more research is needed on this topic. Monica Hallen and others have done similar work in understanding what is the extent of missale that happens in insurance sector. So I think, mandating information disclosure, but importantly in meaningful ways, not as, very long text in 6-point font. I think we know some of that doesn't work, but very important to do more research and work with policymakers to say what is the minimum framework for information disclosure that helps consumers take meaningful decisions, even while acknowledging that just disclosures may not be enough, but at least I think the study shows, given the quantum of potential impact, it is worth doing more work on. The final case study from a different, kind of end of the spectrum is digital consumer credit. Again, something that, as you all know, is thanks to a lot of technology enablement that we talked about already. We are seeing the emergence of a lot of what we call app-based lending, which is quite simply download this app, provide us this basic minimum information, and lo and behold, you are eligible for a credit line. This has been a growing phenomenon. This has particularly increased in salience during the COVID period for a number of reasons, even among low-income groups, right? And so CGAP, World Bank's sort of financial inclusion arm, their research suggests that India has more than 150 apps, digital apps operating as of July 2021. And these are regulated ones, 150. In addition, I think we know that there are plenty of unregulated digital lenders that while the regulated ones work with regulated financial institutions, be it banks or NBFCs, to lend from their balance sheets, the unregulated apps are operating outside any formal framework and lending out of own funds. Interest rates here, no surprises, tend to be quite high, estimated between 300 to 1200% on an annualized basis. But what the consumer often experiences is short durations of lending, 30 days, 60 days. But when you take those interest rates and annualize it, these tend to be pretty jaw-dropping numbers. But I would say much more worryingly, what is being seen and documented is some of the collection practices. So digital lenders in India, they seem to be following a fairly aggressive practice of debt shaming. So the modus operandi seems to be, while installing the loan app, borrowers are forced to provide consent to the app to access contact lists, call history, your location, your Facebook friends, photographs. And essentially then these apps are using this data in the case of delayed or missed payments to pressure customers, borrowers in frankly unprecedented ways. So I think this is sort of the ugly side of some of the kind of credit explosion. And while all of these companies have really made it very easy for people to borrow, and of course that is welcome, I think the channels to then for consumers to raise grievances, talk about predatory behavior, continue to operate in an older world. So your access to loans is right at your fingertips, but access to grievances is still stuck in your older world of go to your ombudsman and write a letter to the ombudsman, then the ombudsman will forward it to another officer. So I think in many ways, we also need to rethink how we design grievance redress, how we align it to modern finance, because I don't think we want to stop the tide of growth in financial services. It's taken a lot of effort for us to get there. But I think if we don't make the concurrent investments in also getting our consumer protection grievance redress framework up to speed, including exploration of online dispute resolution mechanisms, for instance, I think that the gap is going to widen. And the other kind of point I would note here, if something NCAER can take up further, is also more urgency around the data protection law, because until we have a formal horizontal law that really sort of tells providers, whether in the financial sector or otherwise, what data can you collect, how should you store it, how do you destroy it, what can you not do, etc. I think without that framework, we are really building this huge sort of house of cards. So that legislation in particular seems overdue. And I would just say ultimately the market, given that, the conference is being organized by the Investor Protection Group, the market is always going to be 2 steps ahead of regulation and many steps ahead of the unsophisticated consumer. And most of us, irrespective of education levels, are at the end of the day unsophisticated consumers. It is also worth acknowledging that there is always going to be that gap. So education, information, disclosures are important, but not quite enough. I would definitely make a pitch here to say that we should expect more from financial services providers. One of the things at Dvara we've pointed to a lot, particularly from other jurisdictions, is this notion of suitability, to say that a financial services provider at the end of the day does have the responsibility to make sure that what's offered to the customer, whether it is at a branch, whether it is through an app, whether it is through an agent, what is offered to the customer should at the end of the day be matched to the risk preferences, to the liquidity preferences of the customer. So for example, if we were careful about suitability, it would not be possible for a branch manager to offer a very high risk AT1 bond to a retired individual who at that stage of their life, it's pretty clear, cannot take a lot of risk exposure. So education, I think disclosure builds a certain level of confidence to transact, but I think equally important that be accompanied by expectations from providers to be responsible to offer suitable products. And at the end of the day, also, of course, regulation that is responsive, because the kind of risks that I talked about, particularly on digital consumer credit, I mean, these were not even in our radar 18 months ago, but the pace at which these can become large customer protection kind of challenges, I think we're really seeing that accelerating. So I think it also a good moment for us to rethink what supervision looks like in this environment. And really the bottom line for me is that all of this put together should give consumers, particularly new to the system consumers, the confidence to transact, and that if a mistake is made, that is reversible, that it is not, we don't end up creating millions of disgruntled, unhappy consumers and in a way push them back to the informal economy. So let me stop there and really look forward to the discussion.
Thank you. Thanks, Binduji. That is an excellent overview on the various issues surrounding sort of deep financial inclusion, especially the consumer protection angle that you brought out in all aspects of the financial sector. Let me thank you for that. It is now my privilege to call Mr. Challa Setty, who has been MD State Bank of India from January 2020. From April 2020, he's been looking after retail and digital banking. Mr. Shetty holds a bachelor's degree in agriculture and is a certified associate of the Indian Institute of Bankers. He started his career with the SBI in 1988 as a probationary officer And excuse me, over the next 3+ decades, he has spent time in corporate credit, retail banking, banking in developed markets. And prior to taking over as MD, Mr. Setty was looking after the stressed asset resolution group of the bank. And in his capacity as MD, he also looked after various other sectors, including power, infra, auto, telecom, etc. And prior to this, he's held many positions in the SBI, including SBI New York branch. Over to you, sir, and we look forward to hearing your perspectives on the financial system, the much more formal side of it, and its role in financial sustainability, including the aspects of inclusion. Thank you. Over to you.
Thank you, Dr. Gupta, Mr. Krishnan, and the NCR for giving this opportunity. I think Mr. Bagai had covered a lot of international aspects, and I take Mr. Bagai's invitation to look at the financial initiative as a FI from India. I will get in touch with you, sir, separately. And Ms. Ananth, of course, had echoed an outside perspective. I can call it an outsider perspective, but I can completely relate to many issues which she had flagged, for the simple reason that today we are the largest bank with 460 million customers. Out of this 460 million customers, 163 million customers are financial inclusion customers. And out of this 163 million customers, 124 million customers are serviced through a banking correspondent. So what I'm trying to say is that I think we have the largest stakes in the financial inclusion landscape in the country. Having said that, what is the journey so far has been is a remarkable one in terms of the 3 pillars, what we talk about: access, usage. What we probably, Ms. Ananth focused on the quality aspects of this financial inclusion activities which have happened so far. If we see the access to financial services, I think the mainstream banks have played a significant role, starting with the important element of JAM Trinity, what Mr. Kant spoke about. We have now more than 46 million Prime Minister's Jan Dhan accounts, which was the first step of financial inclusion which had happened in this country. Open a savings bank account to those people who have never ever looked at what is a bank account all about. I think that was the first step, and a very, very significant step at that. Then the next step, what was the, I think the important and the most seminal development has been the payment space. Having given this savings account and covered by the direct benefit transfers, a large scale payment infrastructure which had developed had also helped them to come and use these accounts. Imagine if there is no payment service, there is no banking correspondent, there is no Aadhaar enabled payment services. Many of them would not have used these accounts at all. So the access has been further strengthened. The third part is that the institutional support mechanism, what had happened, from the mainstream banks which have opened these accounts, when it came to the next step of the access to credit, a low-cost access to credit was intended. While the banks, mainstream banks, can give a low-cost, low-interest rate financial products, particularly credit, the servicing of those loans, because it is a rigidity of the cost structure of the mainstream banks, which had promoted the microfinancial institutions. I think the NBFCs and MFIs had played a critical role on the last mile connectivity. So on the access front, the trinity of, again, the banks, NBFCs, and microfinancial institutions more or less covered the the institutional setup. Now what comes to is that what are these basic banking services, are the financial bouquet of services which we are looking at? While the savings are taken care of, largely in terms of the basic savings account, the credit is still expensive to them because it is dispensed to the microfinancial institutions. The mainstream banks to do this microcredit, they're not able to break these cost barriers because while you can deliver the credit digitally, most of the banks have developed the capability to deliver the credit digitally. Their high cost model of collection is impairing their ability to lend directly to this the last mile microcredit, which of course it is also realized there is only so much what the cost can be reduced. So the co-lending and on-lending models are widely used. The on-lending has not reduced the cost of credit to the ultimate consumer in these areas. Hopefully the co-lending models where the blended rate is being reduced, will further bring down the cost. So the access to credit is definitely going to improve. On the insurance part, the large scale micro insurance, basically the thrust given by the government in terms of PMJGBY and PMSBY and the pension products to the Atal Pension Yojana, which are largely again delivered through the low cost model of the customer service points, our banking correspondent channel, has enabled a lot of people to avail this insurance. There's a huge gap still, I think, that is sought to be bridged, where the Prime Minister himself has mentioned in his Republic Day speech that this micro insurance should be a thrust area for all the players in the financial inclusion space. Hopefully this area is also going to be covered. The other part is in terms of skill development, which is a financial inclusion item. The NRLM and NULM have been a great success. Self-help groups, joint lending groups are widely financed. But what we have to look now is that move away from this group financing and identify the entrepreneurs out of this self-help group members who can start on their own. For instance, State Bank of India started a program called Shri Shakti, where we will identify some of these women entrepreneurs who would like to come on their own and start the activities. Those are funded individually away from the group, so that they will also develop on the entrepreneur skills. I think RCTs are also an important element in terms of creation of self-employment training institutions. Here, the constant review of the trades identified in the RCTs and how do we make them go for credit linkage instead of actually purely focusing on the employment-oriented trades to the self-employment-oriented trades is something I think where they need to be an entrepreneur when they come out is very extremely important. And the large number of RCTs are supported by the banks, including State Bank of India. The other critical element, what Ms. Ananth at length had focused on, the two elements which go hand in hand, in my view, is the financial literacy and the customer protection and grievance redressal. I think this is one area with a formalization of large number of people and a large number of people being brought into the financial formal financial system, coupled with the digital India stack what we have created, is also helped in mushrooming a lot of unscrupulous elements in the system. So that is particularly the unregulated entities. The biggest challenge is that banks and NBFCs and MFIs as regulated entities are not immune to the actions of these unregulated entities. I think whatever is happening through these unscrupulous elements ultimately land in the lap of the mainstream banks. For instance, I give, if I have to make them more digital financial literate, and I want to bring them in the inclusive space of digital financial transactions, we are giving an app. Are we giving an internet banking access? Are we giving mobile banking access? Because there's not adequate literacy there. They're being duped by many people. And largely, all these people come to the bank and say that, that I've lost my money, please compensate. So it is in the interest of the mainstream banks probably is that a large-scale literacy program, a large-scale education program has to be undertaken. It is not only about financial literacy now, it is digital financial literacy, which is important. I also understand what Ms. Ananth said in terms of the explosion of the financial transactions require that the capacity building, both at the operating level as well as technology infrastructure level, is very critical. We have learned from the first phase of direct benefit transfer, which had happened immediately after pandemic is hit, where she was mentioning about higher technical declines. Today, I'm glad to say that many banks have brought down these technical declines by augmenting the infrastructure. But I think now the mainstream banks, particularly because they are providing the backbone to all these transactions which are happening in the system, need to look at what is the requirement for the next at least 5 years and build the systems accordingly. I fully agree with that. And she has also mentioned in terms of the customer protection, the suitability of products. I think is very, very important that what is being sold to these newly discovered consumers in these rural and semi-urban areas for the financial services products. I think when compared to many of the consumer products, where they can probably understand what are the pitfalls of buying a product, the financial services are packaged in a manner that I think they're not able to understand clearly. Today in SBI, for instance, we do not roll out any product to any of these financial FI customers unless it is personally approved by me at the highest level. So I think that kind of consumer protection angle has to be built into all of our asset and liability products, and also non-banking products, which we are going to roll it out for the financial inclusion customers. So finally, sir, I think it's a huge topic. There is no end to that. I think we can debate and explain what is happening in the market at length. There is a need for a coordinated approach for all the financial segment players in the financial inclusion. I think it's not about whether banks are not doing enough, our regulator is not doing enough, our government is not doing enough. We all have to look at anything what we want to do in this space. How is it going to impact the ultimate consumer? And the ultimate consumer who is much more vulnerable than many of the customers operating out of metro and urban centers. I think this coordinated approach is extremely important. I'm sure the institutions like NCAER can guide all of us in providing the insights and the developments in this space, both domestically and internationally. Thanks once again for giving me this opportunity, and thank you very much.
Thank you very much, sir. That is again an excellent overview of the formal financial system issues relating to the subject under discussion. As we approach the end of the program, it's my privilege to invite Shri Manoj Pandey. Manoj is JS Joint Secretary in the Ministry of Corporate Affairs, as well as the CEO of the Investor Education Protection Fund Authority of the Government of India. He has previously served as Commissioner of Income Tax and as additional DG and advisor at the Competition Commission of India. In his income tax roles, he has been part of the Advanced Pricing Agreement team under the Principal Chief Commissioner of Income Tax, negotiating transfer price agreements with multinational corporations. He has been on deputation with different ministries and departments of the Government of India, including the Department of Expenditure, Ministry of Finance. He has been a part of several international delegations, participating in conferences of the International Competition Network, BRICS and UNCTAD. Manoj holds a bachelor's degree in law and a master's degree in business administration. Manoj, as the sort of the heart of the issues that we are discussing, namely investor education and protection. It will be our privilege to listen to your closing remarks on the topic that we're discussing. Over to you, Manoj. Thank you.
Namaskar, sir. Sir, it's indeed it's privilege to be part of this esteemed panel on the topic, sir, investor education and awareness for strengthening financial inclusion and as enabler of developmental goals in SDG 2030. Sir, listening to the pearls of wisdom coming from you and other panelists was really a pleasure. When we look at, sir, UNCDF site and its motto, unlocking public and private finance for the poor, it would reveal that financial inclusion has been positioned prominently as the enabler of other developmental goals in the 2030 SDGs. And out of 17, I think 8 would talk about in one way or other financial inclusion. And everybody accepts now that financial inclusion can support overall economic growth and the achievement of broader developmental goals in countries like India and in other developing countries. As previous speaker said, that India has taken giant step towards financial inclusion in the form of Pradhan Mantri Jan Dhan Yojana, a national mission for financial inclusion to ensure access to financial services. Once Finance and Corporate Affairs Minister said in one of the events that the journey of Pradhan Mantri Jan Dhan Yojana has led interventions undertaken over a span of 7 years, produced both transformational as well as directional changes, making the emerging financial inclusion ecosystem capable of delivering financial services to the last person of the society, the poorest of the poor. That is the last mile connectivity issue which was being discussed. The underlying pillars, banking the unbanked, securing the unsecured, and funding the unfunded, has made it possible to adopt multi-stakeholders collaborative approach while leveraging technology for serving the unserved and undeserved areas as underserved areas as well. So both serving the unserved and underserved areas. So this is very important, the two areas where we have to reach out to the last person. The statistics were being discussed, and according to statistics from the Finance Ministry, the number of Jan Dhan accounts are now at 43.04 crore in August 2021. It's a significant jump from 17.9 crore in August 2015. And deposits, I think, runs into 1.46 trillion. Now it's a huge sum of deposits which are with the banks. And out of the current account holders, majority are women, that 55.47%, that is as per statistics, and 66.69% are located in rural and semi-urban areas. So it goes without saying, sir, that financial inclusion is among topmost priorities of the government. And it also provides an avenue to the poor for bringing their savings into the formal financial system. If you recall, sir, while launching the program in 2014, Honorable Prime Minister described the occasion as a festival to celebrate the liberation of poor from a vicious cycle. The RBI released a National Strategy for Financial Inclusion in January 2020 and observed that as of mid-2018, more than 35 countries, including China, Brazil, and Indonesia, have a national financial inclusion strategy. And the common themes which would run across all these nations is a target-based approach, targeting specific sectors, is strengthening requisite infrastructure of payment mechanisms, strong regulatory framework, focus on last mile delivery and financial literacy, use of innovative technologies and innovations, and periodic monitoring and evaluation of progress. Now, all these points, if you we just have listened to the speakers, they have covered. So this shows that the policy making is in right direction. Several steps have been taken towards financial inclusion, apart from PMJDY, like Suraksha Bima Yojana, Atal Pension Yojana, Pradhan Mantri Kisan Maan Dhan Yojana, Pradhan Mantri Shram Yogi Maan Dhan Yojana, and Pradhan Mantri Mudra Yojana. So it is all aimed towards bringing the excluded sections into financial mainstream and enabling them to access basic and varied financial services such as basic saving bank account, need-based credit, remittance facility, insurance, and pension. The 6 strategic objectives which were identified by RBI serves as a national strategy, and that was also being discussed here: universal access to financial services, providing bouquet of financial services, access to livelihood and skill development, financial literacy and education, customer protection and grievance redressal, and which was Ms. Bindu Ananth. In fact, she pointed out towards this specifically and effective coordination. Now we come to NSFE 2020-25, which has been released by Deputy Governor RBI, which has recommended 5 C's approach, which is content, capacity, community-led model, and communication strategy and collaboration among various stakeholders. After listening to all these speakers, what I believe, sir, that corporates must work towards building platforms and instruments. Corporates mean not only the banks, but also the other financial institutions which are working towards providing financial products with 3 E's, and which was rightly pointed out by both Mr. Challa Setty and Ms. Bindu Ananth: ease of availability, ease of accessibility, and ease of use. Because this will help a large people of the country to bring them in fold of financial inclusion. The people should not feel prohibited from using a platform or a product. So it should be easy to use, and ease of availability and ease of accessibility must be ensured. The other points which are very important are: 1, disclosure requirements, as was emphasized by Ms. Bindu Ananth, which would be the key parameters for bringing more and more people into the financial mainstream and financial markets. How to make the people more and more aware of the better products so that they do not fall prey to the sham and fraudulent transactions. She rightly said that once confidence is lost, there is lurking fear of forcing the people who have joined the formal sector into informal economy again. We have to make technology robust and secure so that the people who want to be part of formal economy do not become vulnerable and leave the space. And this is what Mr. Challa Setty was also saying is happening in the market, because the technology has to be made robust, and there should be augmentation of the capability and capacity. Education on products is important. Still, how many people know the share markets and its nuances? That is to be studied. And they find it intricate. They find it intriguing. And enough confidence is to be built in when our Sensex is more than 60,000 at present, when more and more people can join and use and bring money into the capital market. But the enough confidence is to be given in the system so that they feel secure and protected. Ministry of Corporate Affairs as a regulator has always been conscious of these challenges, as the motto on the website says, empowering business and protecting investors. National guidelines for responsible business conduct brought out by the ministry in 2018, part of government pursuits to equitably deliver benefits of growth by engaging Indian corporates in the country's developmental agenda. The guidelines articulate a set of 9 principles and their attendant core elements which enunciate the thrust of UNGPs on business and human rights and SDGs. Now, so let me position the role of Investor Education Protection Fund Authority in the areas of financial inclusion, investor awareness and protection in brief. As you would be aware that Investor Education and Protection Fund Authority came to be established in year 2016 under Section 125 of the Companies Act, with the twin objectives of one, refunding back the unclaimed amounts and dividends and underlying shares to the claimants, and greater role provided by legislation to promote investors' education, awareness, and protection. There is an express legislative mandate in the Companies Act to promote investor education and awareness, which is with IEPFA. Very brief on claims refund part, we have settled more than 19,000 claims, which amounts to market value of more than 1,000 crore. This means that almost money which was lost has been given back to the people, the legal heirs, rightful owners, and claimants. It also gives an insight about the whole behavioral part of different stakeholders who are part of the economy, that why the dividends could not be claimed or the shares came to IEPFA from the companies. That is a case study which should be done by somebody, associated with these financial products, to find out the behavioral part of the people, which is part of behavioral economics nowadays. Now, towards awareness on financial inclusion and investor awareness, in last 4 years, IEPFA, as you are aware, sir, as IEPFA Research Chair, has organized investor awareness programs in both rural and urban areas. The authority has collaborated with various organizations like CAC Governance, India Post Payment Bank, Nehru Yuva Kendra Sangathan for the purpose of investor education and awareness, thereby propagating financial literacy among the masses. For spreading awareness in urban areas, the authority also has collaborated with professional institutes. So our aim is to reach to the rural, semi-urban, and urban populace for dissemination of financial education and investor education related messages. And that has resulted in more than 55,000 investor awareness programs as of date. IEPFA Chair on Regulation and Program of Economic and Regulatory Research, of which we are honored that you are chairing it, established at NCEER for a period of 5 years, with an aim to conduct and publish research that will help improve the investor climate in India. IEPFA has also set up a research chair at Indian Institute of Corporate Affairs to conduct research on contemporary issues relating to investor education and protection, and help develop theoretical and academic foundation for the same. On media and advocacy part, webinars, extensive use of social media, mass media like Lok Sabha television, scroll messaging on Doordarshan, panel discussion programs on AIR were successfully conducted and are still being shown on Doordarshan and Lok Sabha. Through sponsored programs on All India Radio, we have endeavored to reach out to the masses in both rural and urban areas. IEPFA has also collaborated with IGNOU Gyan Darshan channel for exploring the option of imparting investor education through distance learning mode. About 26 episodes of 1 hour duration, each on subjects related to financial education, investor awareness education, were telecast live from 10th March 2021 till 13th August 2021. So though the content of 50 lectures have been created through this endeavor, and all these lectures have also been uploaded on social media and like IEPFA's YouTube channel. Now, to reiterate its commitment to improve service delivery to citizens and faster grievance redressal, IEPFA has launched its mobile application on both iOS and Android platforms. So various contents of jingles, infographics, other e-learning, investor-centric contents are being posted on the mobile app. An effort would be made to popularize the IEPFA mobile app and encourage more citizen engagement through inclusion of new content. So recently, a series of short films titled Hisab Ki Kitab, developed by CAC Governance, was launched. These films were well received by the citizens, and I'll encourage all the panelists present here to go just visit the website and see the films, which will give a glimpse of why some topics are very important, like importance of budget, savings, importance of insurance schemes, various social security schemes of the government, etc. IEPFA has also tied up with banks like Bank of Baroda, Kotak Mahindra, ICICI, IndusInd Bank to spread the message of financial inclusion. So I'll request other banks also using this platform, including State Bank of India through Shri Challa Setty, to join hands with IEPFA. Mr. Setty rightly said that to make investors aware of the fraudulent transactions and unscrupulous elements, we have to start a campaign. I'll request him to have IEPFA on board to take the message forward. Owing to the fact that financial inclusion in the country is poised to grow exponentially with digital savvy millennials joining the workforce and social and digital media blurring the lines of rural-urban divide, therefore in future, IEPFA is endeavoring to adopt segmental approach in conducting IEPFA. As we have observed and seen, multiple agencies are working towards financial education literacy with an aim to give fillip to financial inclusion. All agencies should collaborate extensively to provide necessary momentum to reach out to the people, educate them, and bring them into the fold of financial inclusion. As per National Financial Literacy and Inclusion Survey 19, of which we all are aware, only about 15% population probably are in fold of financial inclusion, and level of financial literacy stands at 27%. So we have to cover a lot of distance, and it's time to make it a mass movement and a campaign. And in mission mode, all agencies should start working. I believe, I reiterate, whatever I think I second the comments of and observations of Ms. Bindu Ananth, that what is important is the confidence building in the entire system and adequate disclosure requirements at the formal space, so that people have the enough confidence to come to the formal economy. With this, I'll conclude my observations, sir. Thank you, sir. Thanks for giving IEPFA an opportunity.
Thank you. Thank you, Manoj. As in a sense, the sutradhar of this entire investor education and protection initiative, there is a very comprehensive view of all the formal initiatives of the government. It's now my privilege to request my colleague Sundus to formally thank all our panelists and the audience who joined us at this event. Sundus, over to you.
Good afternoon, everyone. I, on behalf of the IEPF Research Chair Unit at NCAER, extend a generous vote of thanks to all the speakers for gracing this webinar with your presence and sharing your valuable remarks, emphasizing the importance of financial inclusion, financial education, while keeping in line with the Sustainable Development Goals of 2030. We at the IEPF Research Chair Unit at NCAER under the guidance of Dr. Krishnan, are determined to contribute to the investor education and awareness programs and research while keeping investor protection as our topmost priority. Thank you all for being a part of our endeavor to raise financial awareness. A sincere thanks to IEPF Authority for giving us this opportunity, and our in-house communications team, the IT team, and the Office of the Director General at NCAER for their extensive support and cooperation in organizing this event. Have a very good afternoon to all of you. Thank you so much.